Welcome back to EDS, and in this video I'm going to show you how to turn your portfolio into a profit machine that pays you every day, week, month and year. So the first thing you want to do is open up your watch list. This is a pre-made watch list that we've got open at the moment. You can use any watch list, just make sure that you have a nice diverse selection of underlyings on your watch list. And what I personally like to do is filter out anything that has a low liquidity rating level. We're only interested in trading liquid markets. The more liquid a market is, the tighter the bid-ask spread is, and the bid-ask spread is what you pay every time you get in and out of a position. So the tighter the spread, the less you pay, the more profit you keep. Now, what you want to then do is go down the list and see what would fit well inside your portfolio. Make sure that everything is diverse. If you're heavy in any one sector, use common sense and pick something that would complement it nicely. Don't go into that same sector. So you want to go down the list. I've personally got this list ordered from high to low IV rank. Remember, volatility is mean reverting, and we are going to be writing options contracts, which means we're going to be short the options contract. And what that means is we're going to be selling high, buying low. Now, as volatility increases, option prices increase. Now, because we're going to be selling high, buying low, we want volatility to decrease or contract. We don't want volatility to increase. So the higher the IV rank when you get into a position, the more likely volatility will contract whilst you're in that position. So that's why we order everything from high to low. Now, once you've found something that fits well in your portfolio, make sure it has an IV rank of at least over 30. Over 50 is ideal, but over 30 is fine. And make sure that it has a healthy absolute IV level as well. This is a equities watch list, but we are product indifferent, so it doesn't really matter. You can use this on futures as well, but we're not going to go over futures. We're just going to stick to equities. So straight away, GLD is looking nice. It's trading at just over $251 a share. It's got an IV rank of 64.9. It's got an absolute IV level of 16.6%. So now that we've selected an underlying, we want to go over to where we can see a list of expiration dates for that underlying. Now, we want to pick an expiration date that's roughly between 30 and 60 days out in time. We want it to be a monthly expiration date, not a weekly or quarterly. So the only expiration date that actually fits that criteria right now is February 21st, with 36 days left on that contract. Now, GLD is an ETF, so we don't really need to worry about earnings. But if this was an individual company, then you want to make sure that there's not an earnings event over the next 36 days or however long the contract is at the time when you're looking for a position. So in this instance, if this was, say, Apple or Tesla, we'd want to make sure that there is no earnings event over the next 36 days. But with GLD, we don't need to worry about that. And with ETFs, you won't need to worry about that. So February 21st, we're going to open that up. And now we are presented with what's called the options chain. This is where we can see all the calls, all the puts, our strikes, and a whole bunch of other information, which we're going to go into in just a second. So let me explain what's going on here. So this orange horizontal line shows us where the price of GLD is with respect to the strikes that we can see going down the middle here. And we've got this vertical orange bar that shows us what the expected move is of GLD over the next 36 days. We've got these dotted blue lines which show us where our standard deviation levels are, and we also have delta on either side for the calls and for the puts. Now, we're going to be writing options contracts, which means that we want price to stay away from our contracts. Okay, we don't want price to breach our contracts. We want our contracts to stay out of the money. Now, what we're going to do in order to get a high probability of success is we're going to sell contracts outside of this expected move, and the further out you go, the higher your probability of success, but also the less premium you collect. So in my opinion, a happy medium is somewhere around the one standard deviation level, and that's also going to line up typically with a delta of anywhere between 15 and 20. So I personally like to start off with a delta. So we've got a delta of 16 here on the call side, and we've got a delta of 16 on the put side as well. Now what you'll notice is these contracts are now sitting outside of the expected move, and they are in and around the 1 standard deviation level. Now what that's going to do is give us a high probability of success, and you can see that in the bottom left corner here we have a pop of 74%. Now what that means is pop is probability of profit, so that means we have a 74% chance of making at least 1 penny on this trade. Anything over 50% is considered a high probability trade, so we're looking at 74%, which is very high. Now that's if we hold till expiration, but what if we don't want to hold till expiration, and say we want to get out at 50% of max profit instead of waiting the whole duration? Well, we've got this P50 here, which means profit at 50%, and that we've got an 87% chance of hitting P50 at some point over the next 36 days. So we've got a 74% chance of keeping 100% of the premium, and an 87% chance of keeping 50% of the premium. So we're looking at very, very high probabilities of success straight away. That's before making any adjustments if a position moves against us or anything like that. Now what we've got here is essentially we've created a range for ourselves. So price of GLD is currently at just over 251. We've got our short put at 240 and our short call at 265. So we've got this range, and we want price of GLD to stay within this range. Okay, now when this order gets filled, we will collect $2.06 per share in premium. Now each options contract controls 100 shares of the underlying, so you would multiply this out by 100 to get your max profit, which is displayed here at $206. Okay, now we've also got this theta number here. Now theta at the moment is 8.294, so that's $8.29. okay, and theta is time decay. So assuming all else is equal, we would get a daily theta decay of $8.29, which means that this position is going to pay us $8.29 every single day. Okay, now we've still got 36 days left on the contract. Now as we get closer to expiration, theta becomes more aggressive, so this number will increase exponentially with time. Okay, so we're looking at high probabilities of success. We're going to collect $206 up front, and we're going to get paid $8.29 on the straight away. And this number will increase. Theta will increase over time, assuming all else is equal. That's important. Now in order to open this position, our broker is going to require just over $5,000 in buying power. Okay, now you might be thinking $5,000 is a lot of money to allocate to one position, especially if you have a smaller portfolio, and that's completely okay. So what I'm going to do is I'm going to show you how to manipulate this position in order to make it fit inside your portfolio, no matter what size it is. So what we're going to do is we're going to use some of this premium to buy and pay for some long contracts to cover our short contracts. Okay, so let's say if we go one strike down on the call side, which lands us at the 270 strike, and we buy that for 66 cents. As you can see, we're going to be paying 66 cents, so our premium has dropped a little bit. And we're going to do the same thing on the put side. We're going to go $5 wide at the 235 strike, and we're going to pay 51 cents to buy that contract. As you can see here, our premium has dropped to 93 cents per share. However, our buying power is no longer $5,000, it's just $407. Okay, our probabilities of success have dropped a little bit by a couple of percent. We've still got a pop of 70% and a P50 of 84%, so we've still got very high probabilities of success, but we now have a much lower buying power requirement. So we're going to collect $93 up front, and we're going to have a buying power requirement of $407. So what you'll notice now is that we have a much higher return on capital. Okay, so we're giving up a little bit of probability of success in order to get a much higher return on capital. Now, you'll notice that our theta decay has slightly, well, it's decreased by quite a bit. It's now $2.24 as opposed to $8. Now, this is because our long contracts are negating some of the theta decay that we're going to get from our short contracts. Okay, and this is just part of what we have to do in order to reduce our buying power requirement, which is why I would always start off with a naked position. See if you can fit that inside your portfolio, because you will get the highest theta decay with a naked position. And if you can't, then by all means you can buy some longs to cover your shorts. Now let's say, for example, if you wanted to allocate $1,000 or say $800 to this position, so you want to double the buying power requirement, or what you can just do is simply just go a little bit further out. So we're going to go $10 wide, and then we can do the same thing on the put side, $10 wide. And what that's going to do is that's going to increase our theta decay, because now the further out our long contracts are, the less significant they are. So our short contracts can basically put in more work with respect to theta. So our theta decay is going to increase. It's now at $3.88 per day. Our buying power has increased slightly. Our max profit has also increased. So this is how you can manipulate positions and make the numbers fit into your portfolio. And what you'll notice is our probability of profit also increases slightly as well. Now, let's say, for example, you wanted to get a higher return on capital. Well, what you can do is you can be more aggressive with your short contract. So we're at 16 delta at the moment, but let's say if we went to around a 25 delta. So we've got a 26 delta on the call side, and we've got a 24 delta on the put side. But let's just say you wanted to keep the width of our spread on either side to $5. So we can do that. We can just go $5 wide, 1, 2, 3, 4, and 5. So we're now at $5 wide on either side. And what you can see here is we've got a premium of $1.66, which is a max profit of $166, and a buying power requirement of $335. So this is now giving us a higher return on capital than what we were looking at before. Now, in exchange for this higher return on capital, we have a slightly lower probability of success, a POP of 55% and a P50 of 72%. And we've got a daily theta decay of 2.46. Now we can again go wider on our longs. Say go $10 wide if you wanted to increase your buying power requirement. You can do the same thing on the put side, 1, 2, 3, 4, 5. So we're now $10 wide on either side. And what that's going to do is increase our daily theta decay, increase our probabilities of success, but also slightly increase our buying power requirement, and in exchange slightly reduce our return on capital. So nothing is for free in the market. I personally believe that the market is in a state of equilibrium. So if you want to give something, if you want to get something, you have to give something, and this is basically the trade-off. All the numbers here at the bottom are, you can manipulate them depending on whether you want a higher return, higher probabilities of success, whether you want to go naked, whether you want to be covered. It all just depends on the size of your portfolio and what sort of strategies you're implementing. Generally speaking, you want to have a mix of defined risk or covered positions and undefined risk or naked positions. Those terms are interchangeable. And you want to have a mix of, high probabilities of success, maybe some slightly lower probabilities of success, but anything in and around the 15 and 20 delta on your short strikes, generally speaking, as a starting point will be absolutely fine. You can be a little bit more aggressive, go to the 25 delta, be a little bit more conservative if you wanted to, but it all just depends on your portfolio needs. But as you can see here, it's all about creating positive theta decay in your portfolio, and that's what's going to get you paid every day, week, month, and year. Now, how do you know how much buying power you should be allocating to your positions? How do you know what ratio of naked and covered positions you should be having in your portfolio? Well, in order to figure that out, we've created a free position sizing template. The link is in the description, and you just click on this button here and it will take you over to this spreadsheet, and everybody can make a copy of this and use it. So at the top, you enter in the size of your portfolio. So say if you have a $10,000 account. And then what you do below is you enter in whatever the current VIX level is. So say if it's 14.2, and then everything will be automatically calculated for you. It will tell you the maximum amount of buying power to allocate to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. It will tell you the minimum amount of your portfolio to allocate to undefined risk trades, the maximum amount of your portfolio to allocate to defined risk trades, and everything you need is here. As long as you follow this, over the long run, you'll be absolutely fine. And if you want to learn in more detail about what we do and how we do it, the link will be in the description. This time, click on EDS Premium, get yourself signed up, and inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know. If you get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals, and there's a 100% money back guarantee. So after 6 months, once you've gone through the course, follow some of our trades, if at that point you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join at the moment. The price will be increasing. It's super cheap right now because we've just launched. So you are definitely rewarded for getting in early. The price is locked in for you. Whatever price you join at, that's the price you pay, no matter how much the price increases thereafter. And the aim of EDS Premium is to teach you the skill. It's not to keep you reliant on us. It's to teach you the skill so that no one can take it away from you. It's something that you can do for the rest of your life. And we aim to get you to that point within 6 to 12 months. You're always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.